Guys, why don't we start? Okay, so before we start, you guys have had lunch, you might have been digesting, you might have questions. So, any other questions from the morning session that we talked about? I know the gentleman who was asking me the question about taxable capital is not here, but just so you know, I know it makes no sense, but debt is still calculated as part of taxable capital. If you look, if you look at the form in the corporate tax return, we talked about the section I mentioned, but if you look at the corporate tax return for any company, it will show you there's an actual schedule that you have to calculate your taxable capital. And it lists assets. It lists categories, rather, where you have to put the dollar amount. And it does include debt. So the one thing to keep in mind with debt is that it's considered an asset if it's outstanding for more than 365 days. I know it doesn't make sense, but it is what the CRA uses for calculating taxable capital. And I was thinking about why, and I was thinking about it, and without being able to read their minds, at the end of the day, this is for purposes of calculating the small business deduction, which is the low tax rate on the first 500,000. So I'm going to focus on two words: small business. This is for small businesses. So if you have a corporation that has debt in excess of 10 million, that's not a small business, right? I know it's not an asset, but if you have the capacity to have debt for that much, CRA does not consider it to be a small business. So I just wanted to clarify that. If he comes back, I'll mention it to him again. Yeah.
So just to be clear, so does that mean that if you bought an asset with that money, so say you got a mortgage for a building?
Yeah.
So the building is worth $1 million.
Yeah.
So you put $200,000 down.
Yeah.
You get an $800,000 mortgage.
Yeah.
Right. So that calculation, your total assets would be 1.8 million. Right?
Well, you're including the value of the asset. You're including the debt. So what it will be is, here. I pulled up the form because I wanted to show it to him, but hold on. Give me a second. It's easier for me to see here. So it's called taxable capital. The form is Schedule 33. You will not need to know this for your exam.
If that's the case, then just forget it. I don't want to waste everybody's time.
Oh, okay. Well, I'll show you the form after, so you can see it. But they're not going to take you through. Just remember, this is the key takeaway for your exam. The small business deduction is available to corporations who are carrying on an active business in Canada. And once the company hits taxable capital, that's what you have to remember, taxable capital of $10 million, we start to claw back the small business deduction, the availability of it. And once the company hits $15 million of taxable capital, you lose it all. You don't get any of it. That's what you need to know. Okay. I can't imagine why you wouldn't want to know more tax.
Well, I do, but
I'm kidding. When I wrote the exam, I only wanted to know what I needed to know. I get it. Okay. Oh, where's this? Here we go. So any other questions from what we talked about earlier? Okay, so what we're going to talk about now is still in the corporate realm. We're going to talk about amalgamations. So an amalgamation is where we have two or more corporations are amalgamated, merged into one company. The way that I look at it for tax purposes is think about it as if you have two companies that are amalgamating, think of it as two streams coming together and then amalgamating and forming a larger river. The same water in the streams flows through and continues on. So when two companies amalgamate, it is considered to be a rollover. So rollover is our tax term for tax deferred. It does not trigger tax on an amalgamation. Technically, the shareholder, pictures are good, let me show you. So Sam owns OpCo 1 and OpCo 2. We're going to amalgamate these two companies to form a Malco. Technically, me, Sam, I'm deemed to have disposed of my shares in OpCo 1 and OpCo 2 and reacquired shares in a Malco. CRA says that's an automatic tax-deferred transaction. It will not trigger tax. Even though I'm technically deemed to have sold my shares and reacquired new shares of Malco, it will not trigger tax. So that's all good, okay? What it will do is that it triggers a year-end for tax purposes. So let's assume that OpCo 1 and OpCo 2 have different year-ends. Companies can have any year-end they want, any month of the year. It can be any day of the year. So let's say OpCo 1 has September 30th and OpCo 2 has December 31. If we do an amalgamation on, let's say, March 1st, a Malco is now considered to have a year-end the day before, which is February 28th. What does that mean for OpCo 1 and OpCo 2? OpCo 1, who had September 30th, now has a short year-end because it kind of ceased to be, for tax purposes in terms of its year-end, on March 1st. So it's going to have a year-end from the year before. So let's say we did the amalgamation March 1st, 2018. OpCo 1 will have a year-end that will have started on October 1st, and it will end on February 28th. OpCo 2's year-end, which was a December 31st, its new tax year will have been January 1, 2018, and end on February 28th, so it's only like 2 months. That's what happens. It's just the rule. A new amalgamated company is going to have a new year-end, which will be the date before amalgamation. So if you have two companies that you're amalgamating, usually, and they have different year-ends, usually you want to do a date that will coincide with one of the company's year-ends. It's just cleaner. If both companies have the same year-end, so December 31st, you want to amalgamate on January 1st so you keep the same year-end for both companies. So I talked about the streams forming a river. So the tax accounts of OpCo 1 and OpCo 2 will continue. What are tax accounts? Remember we talked about capital dividend account, which is when you can pay money tax-free. We talked about the RDTOH, which is the refundable tax accounts. Those accounts for each of those OpCo 1 and OpCo 2, they don't disappear. They continue on. They keep it. So now a Malco is going to have these tax accounts, which will be the addition of both 1 and 2, OpCo 1 and 2. So we don't lose those, okay? They merge into one, correct. And I talked about how the shareholders are deemed to have disposed their shares. So they are deemed to dispose, so me would have deemed to dispose my shares at my cost base, so it doesn't trigger any tax. So then we look at winding up or dissolution of a company. In the Tax Act, we use the words winding up instead of dissolution, but they're interchangeable. If we wind up a company, so let's say I did this amalgamation. I have a Malco here. And then I decide my company's gone out of business and I want to get rid of it. So we wind it up. What that means is that the shareholder, being me, I'm going to pass a special resolution of the company as a shareholder and say I formally wind up the company. This basically goes away. And what happens is that if there are any assets in a Malco, they go up to me. Technically, for winding up, a Malco, the company, is deemed to have transferred those assets to me. Now, you all know what happens when assets or cash come from a company to its shareholder. There's normally tax. There's deemed dividends, right? But under Section 88 of the Income Tax Act, in certain situations, you can do this on a tax-free basis. If it's an individual, you can't do it on a tax-free basis. It will be taxed to the individual. But if you do it, if you have this structure, So holdco. Oops. And an opco. Ugh. And this is, let's say this is 100%, just argument's sake. Under this section, there's this ability to do a rollover. You can actually wind up opco into holdco as long as holdco owns more than 90% of the shares of opco. You can wind up this bottom company without triggering tax up here. It can happen on a rollover basis. So basically, the subsidiary's assets are deemed to come up at cost base. There's actually, okay, this is a tangent really quickly. There's some neat little tax strategies. When you do a wind up from a subsidiary up to a holding company, you can actually, remember we talked about depreciable assets and you can depreciate assets. If you have assets that are non-depreciable, like land, you can actually, on the wind up, you can bump up the cost base, artificially bump up the cost base of capital property on a wind up. They allow you to do that if you own more than 90%. So it's a neat little tax strategy, so you know. So as I said, if you don't have this tax deferred wind up under 88, you're going to have two elements of tax. This is, remember, we have tax at the corporate level and at the shareholder level. So if I'm here and I wind up holdco, and let's say I have assets here, so a little bucket of assets, what's going to happen is that holdco will be wound up. Holdco is deemed to have sold these assets if they have inherent gain. So if these assets have ACV of 100, but fair market value of 500, you're going to have tax here of $400. That's the difference between the two on the capital gain. And you're going to have a disposition here by me. I am deemed to have sold these shares as well. So there is an element of double tax here. Normally, you don't want to wind up the company if you have real assets here that have a capital gain. But usually, you would only wind up a company. Well, I've only ever done it or suggested we do it. If there's nothing here, if it's just cash, cash doesn't trigger any capital gains because cash is cash. It doesn't grow in value. A dollar is a dollar. It doesn't increase in value. So that's something to keep in mind. So those are two what we call fundamental things to think about with corporations, amalgamations and winding up, and how it's dealt with for tax purposes. So now let's assume I want to sell my widget company. So again, I'm going to work on the assumption that I own it through a corporation. So here's Sam and Samco. So when I sell this, if I sell this business, traditionally, I, as a shareholder, want to sell my shares of the company. And the reason is because in Canada, it's not specific to Ontario, in Canada, when an individual sells shares of a company that is carrying on an active business, the first $800,000 of value, or of the share purchase price, is tax-free. It's called the capital gains exemption. Every single individual in Canada gets this. It's a lifetime capital gains exemption, meaning it's only available once in your lifetime up to $800,000. So, sorry? Sorry.
Can you say that again?
Oh, the lifetime capital gains exemption. So when an individual sells shares of a company that is carrying on an active business, so it has to be a small business corporation, it has to be a CCPC, Canadian Controlled Private Corporation, carrying on an active business, the first $800,000 is not subject to tax. It's tax-free. So that's important. And think about this. If I own Samco, not just me, but if my husband owned it, if my dad had shares, if my mom had shares, and all of us sold, each of us gets to claim $800,000 tax-free. So that means we could theoretically sell this company, and up to $3.2 million is not subject to tax at all. It's a pretty good, a pretty good mechanism for you. So as the vendor, when we want to sell our company, we want to sell shares. That's important. From the purchaser's perspective, they're going to say, no, we don't want to buy the shares. We want to buy the assets that are here. The reason is it's all about taxes that's driving them. The purchaser wants to buy the assets because let's assume we have all this equipment, we have inventory, we've got land and building, all this stuff here, okay? The corporation is probably, remember, depreciating. It's probably writing down equipment. We were talking about that at lunch, writing down equipment, writing down the building. So it's the cost base here is probably gone down to the UCC, so much lower, right? If the purchaser buys the shares of the company, then nothing changes at the company level. The company still has its same cost base, same UCC, everything that it's been there. So whereas if the purchaser bought the assets, and let's say the purchase price was $3.2 million for everything. If the purchaser said, I'm going to pay $3.2 million for the assets, not the shares, that's $3.2 million of cost base that the purchaser has put to the assets themselves, which means for depreciating purposes like UCC, you've all of a sudden written it back up to 3.2, and that's $3.2 million of value that they can start to write down instead of inheriting the old company's cost. So this is always going to be like this. The purchaser's going to be here, the vendor's going to be here. And from my perspective as a vendor, I'm going to say, are you kidding me? I can get all this for tax-free. If I sell here, I'm going to trigger tax to the corporation. Why would I do that? So there's no answer. It always becomes a negotiation issue. A lot of times I find vendors will, at the end of the day, well, actually it depends on who has the leverage. If the vendor doesn't have to sell, the purchaser really wants it, purchaser will probably buy the shares, but maybe there's an abatement in the purchase price, right? Like, so that's when I pass it off to the corporate guys and they negotiate that. So that's one of the key things when you think about when you sell a business. You got to remember that. Okay, so let's assume that we are going to do a sale and we're going to sell assets of the company. So the company is going to sell the assets. So it's selling inventory, it's selling land and building, it's selling equipment. It may also sell goodwill. So what's goodwill? Goodwill is basically, it's an intangible, meaning you can't really touch it. It's just this concept of this company has built, like I built this company from nothing to Widget Co. and it's really well known out there and I have this amazing client list. There's value in that. There's value in that client list. There's value in that name recognition. So sometimes when you buy assets, you will actually say, okay, well the purchase price is $3 million, and we're going to break it down this way. $1 million for the land and building, $200,000 for the other equipment and stuff, and the other $2 million will go to goodwill because that's really where the value is. So a number of years ago, I think we're going back maybe 10 years ago, goodwill, CRA messed up. They didn't have a specific category in the Income Tax Act for the sale of goodwill. So we had a taxpayer who sold the assets of his business, and he allocated a huge amount of the purchase price just to goodwill. And because goodwill was not a particular asset set out in the Income Tax Act, it was tax-free. He didn't said no tax payable. It's not an asset that's subject to tax on a sale. Of course, the CRA argued it, went to court, and the CRA lost. So this guy got this huge windfall. So of course, CRA right away went to work and drafted all this legislation. So now, so goodwill then was subject to tax. Then the thing is, it was getting still a pretty good treatment. Okay, it was getting like capital gains treatment essentially. Then last year, the budget came out, they changed the rules, and now you have to pay basically almost at full rates. So it's not that great. If another reason why a purchaser might also want a sale of shares is that if I sell my shares to Purchaser Co., okay, and part of the consideration, Purchaser Co. says, you know what, I'm not going to just give you cash because it may not have all the cash to pay. I'm going to give you some shares in my company. If I took some of my shares, sold it, and took back shares back, what section are we into? Section 85, the rollover. So you can defer tax if you sell to the purchaser and you take back shares. So some clients do that, right? They're selling, but they're just going to take an equity interest in the purchaser. And so that can trigger some deferral opportunities on the sale. Another way that you can not shelter, but you can defer tax is if I sell, okay, I'm just going to get rid of the rest of my family members here. If I sell my shares to Purchaser Co., and Purchaser Co. says, I don't really have the cash, I'm not going to give you shares in my company, but I'm going to give you a promissory note, so a promise to pay. So you're basically selling to me in exchange for debt. The CRA says that if you don't get cash proceeds on the sale, you can claim a reserve, which basically means, so if I sold this for, I had a capital gain of $2 million, or let's say $1 million, my capital gain was $1 million, but I didn't get any cash, I just got a promissory note and they're going to pay it over time, then I can claim a reserve and I only have to pay my tax over time, over 5 years. So it's a bit of a break for me because I don't really have the cash to pay the tax, so I didn't get any proceeds. That's from the vendor's perspective, correct. So you can stretch out paying the tax to a maximum of 5 years. So you pay 20% of your tax in year 1 and 2, 3, 4, 5. If I sell shares, not shares, but let's say I sell land and building personally. So I have land, building. And I'm not a Canadian resident. I'm from the US. I'm a US resident. I just happen to invest here. In Canada, even though I'm not a Canadian resident and I don't file a Canadian tax return, if I own Canadian real estate or shares of a company that owns Canadian real estate, so my asset is somehow tied into real property, like land, physical land here in Canada, then Canada says, I don't care that you're from the US and you're not subject to tax, you have to pay a capital gain to Canada because it's Canadian real estate. It's them being very territorial. If I was selling shares of a company that was making widgets and I was a US resident, CRA can't tax me on that. US will tax me, but CRA can't because my asset has nothing to do with real estate. It's not what we call taxable Canadian property. So this is what you have to remember for your exam. If a non-resident of Canada sells an asset that is considered to be taxable Canadian property, such as Canadian real estate, that non-resident has to get a clearance certificate from the CRA before the sale. In order for a non-resident to get a clearance certificate from the CRA, they have to report that they're selling the land. They're going to have to report what the purchase price, what they're selling it at. They have to report what is their cost base and what's that capital gain. And they have to pay tax. The tax for non-residents on a capital gain, on the total capital, is 25%. So if I as a non-resident sold land and I had a capital gain of $400, my tax is $100. I have to pay that to the Canadian government. They will then give me a clearance certificate. It's called a Section 116 certificate. I give that certificate to the purchaser to say, yes, I'm a non-resident, but I paid my tax to the Canadian government. The purchaser will want to see that. Because if I don't give the purchaser that clearance certificate on closing, the purchaser is actually liable to pay the tax to the Canadian government, right? So as a purchaser, if you're the purchaser and you're going to buy land from me, you're going to say, Sam, where's that clearance certificate? If I don't have that clearance certificate on closing, I don't give it to you, what you're going to do is you're going to withhold 25% of the purchase price, not the gain, the purchase price. So if you sold the land, if I was selling the land to you for $500 and my capital gain is only $400, so my tax would have been $100, and I don't give you the clearance certificate, you're going to say, I have to withhold 25% of $500, which is the purchase price. So 25% of $500 is going to get you $125, right? $125. So you're going to withhold it, and you're going to hold on to that money. And if I don't give you a clearance certificate within a certain time after closing, it's usually 30 days or 60 months after, depending, you're going to take that $125 and you're going to send it to the CRA on my behalf. So from my perspective, that's bad because you've just paid $125 when really my tax liability was only $100. In order for me to get that $25 back, I have to file a Canadian tax return, I have to claim that as a refund, I have to wait, it's going to take a year and a half before I get my $25 back. So non-residents, they will want to get that clearance certificate, okay? And as a vendor, if you're selling, as a purchaser, if you're buying land and building, you will always want to ask the question, are you, the vendor, a Canadian resident for tax purposes? It will actually be part of your every real estate transaction. There's going to be a representation that the vendor has to sign. If they don't, then you get into this. Restrictive covenants, I'll touch very briefly. I don't think it's going to be part of what you need to do. A restrictive covenant is basically like a non-compete. So if I sell my business, I sell my widget business, but I am really like, that business is doing well because of me. The purchaser is not going to want me to compete. They're not going to want me to open up a new widget shop right away. They're going to say, I'm going to buy all your assets, but I want you to give me a non-compete that you promise not to compete against me for whatever, like 2 years. So sometimes you can actually be taxed on, taxed on this non-compete. Me giving it to you, I say I promise I won't compete. You as a purchaser might actually allocate a bit of the purchase price. You can say, okay, well I'm going to allocate $100 to this restrictive covenant. That is actually going to be taxed at real full income, not capital gains. So there are things you can do to limit that, but you won't need to do that. It's getting and just so you know, the rules are pretty complicated, so you don't need to worry. I don't think you'll need to worry about that. But just know that there are certain rules where you will have to pay tax on a non-compete that you give. And then the only other thing I'd mention here is that this anti-avoidance rule, remember section 55.2, that's the one I told you that of all the sections of the Act, this was the most complicated. If you have a situation where I have, let's say here's OpCo, I have HoldCo, and HoldCo is going to sell the shares of OpCo to like third party here. If before the sale I basically start paying intercorporate dividends, that'll come out tax-free up here, and then I sell these shares, if I do it in certain situations or certain conditions, this intercorporate tax-free dividend will be taxed. So it'll be subject to tax, a capital gains rate. So, so just be aware that when you're selling, you have to be careful about what you're doing right before a sale. Two things I'll mention that are not income tax related. I don't know if this may be there or not, but just on the sale of business, you've got HST, which is GST. So you know 13% you pay on everything, on your coffee, even if on legal fees, I have to charge HST to my clients. When you sell a business, not the shares are not subject to HST, but if I sell the business itself as a going concern, all the assets, that's going to be subject to HST. There is an exception, Section 167 of the Excise Tax Act, Excise, E-X-C-I-S-E. This election says if a purchaser is purchasing all or substantially all of the assets of a business, then you can file this election between the purchaser and the vendor, and you don't have to pay HST. When we say all or substantially all is 100%, substantially all is 90%. And it also works if you are selling like a division of a company, if it's its own kind of standalone division. So if I'm not selling everything, an entire business, but I am selling this one division and it's kind of a standalone, that will also be okay. Land transfer tax. So does anybody here own a home, buy a home? So you remember when you think, okay, I'm buying and spending all this money for a house, and then Ontario and Toronto say, don't forget me, you have to pay land transfer tax. Land transfer tax is a provincial tax for Ontario and a municipal tax for Toronto. It says whenever you sell land, land and building in Ontario, Ontario will charge a land transfer tax. Land transfer tax is basically equal to 2% of the purchase price. That's Ontario's land transfer tax. And then a number of years ago, Toronto got greedy and thought, hey, this is like a boondoggle, I'm going to do it too. And they piggybacked on the provincial land transfer tax legislation and put in place a municipal Toronto land transfer tax, also in the range of 2%. So now when you buy a house in Toronto, you're paying land transfer tax to two different governments. And it's not money you can get back, it's lost money. So you have to be mindful of that. When would this be applicable? Well, first of all, if you're buying homes. But remember our example of Mr. Jackson, who was transferring land and building to his company? Remember we said we can transfer it in without triggering capital gains tax, right? Because we did it under Section 85. Guess what? If that building is in Ontario, land and building, he has to pay land transfer tax. And if the land and building is in Toronto, he has to pay Ontario land transfer tax and Toronto land transfer tax. That is separate from income tax, but it is a cost to transferring land and building, unfortunately. And the land transfer tax is based on the fair market value. So remember in that example we had, I think it was $175,000 was the fair market value. So it's not based on your cost base, it's based on your fair market value. Okay, so that ends corporations for now. Before we move on to trusts, any questions? Yes?
The $800,000 capital gains exemption
Yeah.
for reducing shares. So how was that triggered?
How is it
How was it triggered?
triggered?
Yeah, I mean, if you sell, for example, 50,000 shares.
Oh, yeah. So yeah, you don't have to claim the full 800,000 in one transaction. So if I sell shares and the first sale of shares is only worth 50,000, I will, on my tax return, I'll report I sold these shares. My purchase or a capital gain is $50,000, and I'm going to claim my capital gains exemption. So now that'll offset it, and you don't have to pay tax. Now my capital gains exemption is only at $750. So it's like you can use it in multiple times, right? So that's okay. Okay, trusts. So, trusts are a funny animal. For tax purposes, a trust is a taxpayer. It has to pay taxes, and I say it has to in certain situations. If it has net income, it has to pay taxes, and it has to file a tax return. It's called a T3. T3 is the tax return for trusts. The funny thing is, do you remember I said at the very beginning that legal entities have to pay taxes? Remember, a partnership wasn't technically a legal entity, so it doesn't have to pay tax. So a trust is actually the anomaly here. It's not technically a legal entity, but it is a legal entity for tax purposes. CRA says we consider it to be its own separate taxpayer. So there's all sorts of trusts out there. you can have a trust that we call a testamentary trust. A testamentary trust is a trust that's created in a will. So let's assume I die, and I have 2 daughters, Maya and Lila, and they're minors, and I can't give, my assets out to my daughters. So I create a trust in my will. So when I die, that trust then comes into being under my will. It's called a testamentary trust. That's a testamentary trust. There's also what we call an inter vivos trust. Inter vivos trust is basically, people call it a living trust. It's basically a trust that I create while I'm alive. So I wanted to create a trust for my daughters. I form a trust and I put assets in it. So I'm still alive while my kids are beneficiaries, and that's called an inter vivos trust. Then there is, if you have an inter vivos trust, living trust, you can have different types. You can have a trust that is, how do I call it? My daughters, let's say I've already created who gets what. So I created this trust and I say the assets are going 50-50. So 50% of the benefit of the assets in the trust are going to my eldest daughter. The other 50% is going to my youngest daughter. It's crystallized, that you can't change that up. The second type of trust, which is really what we're going to talk about because that's the most interesting and the most common for tax purposes, is what we call a discretionary trust. Discretionary means I set up a trust and I say it's for the benefit of my daughters, but I don't say what they get. I don't say what percentage of the assets they get. I just say my beneficiaries are my issue, my daughters. And the trustees, I give the trustees all sorts of powers, and one of those powers is the ability to decide at any time whether to make a distribution out of the trust to my daughters, and moreover, they can decide in what proportions. If they want, they can give everything to my eldest. They can give it all to Maya and nothing to the baby, nothing to my youngest. They can do that. That's part of what we call it discretionary. The trustees have absolute discretion to decide who gets what and when. The thing about these discretionary trusts is, for tax purposes, as you'll see here in the second bullet, they're bad, right? They attract the top rate of tax, 53.5% in Ontario. But not just that. So remember, individuals on income over $220,000 in Ontario, an individual has to pay 53.5%. But before that, individuals pay tax at graduated rates, right? So like the first $11,500 is tax-free. The next rate of income is, and I don't really remember them offhand, but the next rate of income you pay 15%. The next rate will be 25%, right? It's like income up to 11,000, and then income between 11,500 and 25,000 is taxed at this rate, and goes on. So as you go up, as your income becomes higher and higher, you'll pay more tax, but it's only on that tax is above. So when I say 53.5% for personal income tax, it's only on that income that's over 220,000. The difference between a trust is that if it only makes $11,000, it's paying 53.5% on $11,000. It does not get access to these graduated tax rates. And before 2016, testamentary trusts created under the will also got, they were the exception. Testamentary trusts created under the will were able to get access to graduated rates. But they changed the rules. So as of January 1, 2016, testamentary trusts are also taxed at the 53.5% unless, except for one exception. If a testamentary trust is designated as a graduated rate estate, this is getting a little wonky here, but you'll be able to get the graduated rates for its first 3 years of existence. You only get one trust at that lower rate, and after 3 years, that testamentary trust will be taxed at 53.5%.
Everybody choose to elect that 3-year option.
Yeah, so when you die, if you only have one trust that's created, one estate, you'll get that. But if I set up 2 different trusts, one for each of my daughters, I couldn't do it for both of them, only one of them. And you only get it for 3 years, right? So after 3 years, and normally these type of testamentary trusts go on, like, normally I would say, oh, well, it's going to be in place until my kids reach the age of 30, right, which will be more than 3 years. And so that, so it doesn't help right after 3 years. So why would you ever do a trust if you're paying taxes? So I'm going to go back to the discretionary trust, the inter vivos. Well, I said it's a taxpayer and it files a tax return and it pays tax if it retains income in the trust. Otherwise, it's what we call a flow through. So if we have a trust, all right. So here is the trust, okay? So it's the Sam Prasad Family Trust. And my beneficiaries, I have my daughters, Lila, I have Maya. So if the trust earns $100 of income, and a trust, by the way, has to have a December 31st year end. That's important. We're going to talk about it at the end, but just so you know, it has to have a December 31st year end. So if it earns $100 of income in 2017, and we leave that income in the trust until the end of the year, that's income to the trust, and it's going to be paying $53.53 of that $100 to the Canadian government. But if before December 31, the trustees say, okay, $100 came in, we're going to make a decision to allocate income. So we'll get back to that word allocate again, partnerships. We're going to allocate that income out to the girls. So we're going to give $50 to each of them. So here's $100 in total. So the $100 came in income, and it paid out, it allocated out $100. For tax purposes at the end of the year, the trust is going to show on its tax return income of 100, and then basically a deduction of 100 because it allocated it out. So at the end of the year, it will have 0 income. So you don't have any tax at the trust. But the girls, the beneficiaries, they have to report the income. So they're each going to file a tax return and claim $50 here, $50 here. And the only way you can do that, and by the way, think in terms of my daughters, they're not earning any other income. So they're in the low tax bracket. So we're saving money here, right? They're in lower tax brackets. So the only way you can do that is that you have to ensure that the trustees say that the income is paid, meaning they actually pay it, cut a check of $50 to each of the girls, or they make it payable. Payable means that they have allocated and said, yes, we are going to allocate $50 to each of the girls, and now that is an amount we owe the girls, and the girls actually have a legal right to enforce payment of that money. That's when you make it payable. If you do that before, and it has to be done before December 31st, then you can tax it in their hands and not the trust. So I talked about how this deduction, and it has to be payable, and it will be included in their income, right? So generally speaking, the type of income in the trust, when it goes out, flows out to the beneficiaries, it will, you have a question? Yeah?
Sorry, so alternatively, if you left it in the trust, then you would have been taxed at 53.3 million.
Yeah.
Even if it was testamentary, right? And either.
Whether it's a testamentary trust, yeah. So for purposes of our discussions, we're going to talk not about testamentary trusts, we're going to talk about regular discretionary trusts. Because I think, again, I can't say for sure, but you guys are being tested on wills and estates and stuff like that, right? So there will usually be discussions about, I don't know if you've done the course yet or not. So they talked about testamentary trusts. Did they talk about the tax aspect of it? No? Oh, did they? Yeah. So today we're just doing the pure tax, and we're not going to talk about testament. Everything is assuming it's a regular inter vivos discretionary trust.
So if you didn't do that, then the $100 tax.
53.5, yeah, in the trust, which is bad. We don't want to do that, right? So now let's talk about, remember, the types of income. This is true. It doesn't matter who earns income, whether it's an individual, whether it's a corporation, partnership, or trust. You have to look at the type of income to determine how it's taxed, at what rate. So is it regular income, which is all of it subject to tax, or is it a capital gain? Remember, only half of it subject to tax. So typically, if the trust earned regular income and it allocates it out, it retains its character, typically, okay? Same thing. If the trust earned a capital gain and it allocates the capital gain, the girls will declare it as a capital gain and only have to pay tax on 50% of that, okay? So there are other types of income that may not necessarily retain its character, but what you do, the income, this is the income you have to remember that will retain its character, that you can flow it through. Regular income, capital gain, dividend income, taxable dividend, as well as capital dividends. Remember capital dividends? Those are the good ones. Those are the tax-free dividends. So if the trust happened to own shares of OPCO, and OPCO paid a capital dividend of $100, meaning it's tax-free, and it comes to the trust, and the trust allocates it out to Lila and Maya, it will still retain its character, and the girls will get it as a capital dividend, so it will be tax-free to them. So pretty good, right? Trusts are sounding not so bad. So there are rules. CRA says, yeah, we acknowledge trusts are a pretty good planning tool and for tax purposes, but we're not going to let you do it forever. There is a rule in the Income Tax Act that says if you have a discretionary trust, on the 21st anniversary of that trust, the trust is deemed to have sold all of its assets. And if those assets have gone up in value from the original cost base, capital gains tax is going to apply. So even if the trust didn't sell anything and it has no money, didn't get any proceeds, it's considered to have sold the assets and it has to pay tax. That's not great, right? This is CRA's way of saying you can't just park assets in a trust and it never get taxed. Like, because let's assume you didn't have this rule, and I put shares of OPCO in here, and their cost base is $100, and I let it sit there forever and ever and ever through 5 generations of my family. There will never be tax on these shares, ever. You can continue deferring tax until you eventually the trust sells, because what would happen is if my kids were beneficiaries, but I also said that the beneficiaries are my kids and my grandkids and my great-grandkids. You can declare them as beneficiaries even if they're not yet alive. What we would just say is, oh, well, you know what? We're never going to distribute these shares to the kids so that when Lila and Maya pass away on their death, they don't have any tax because they don't own the shares directly. They're just a discretionary beneficiary in a trust. They don't own anything. So you could have like tax being deferred until, forever. So CRA says, nope. On the 21st anniversary, this trust is deemed to have sold these shares. So if it was cost base was 100 and its fair market value on the 21st anniversary is 500, trust has to pay capital gains tax at 400. So what do you do? Like, how do you avoid that tax? So there's all sorts of planning steps you can do. The easiest planning step is you wind up the trust and you distribute these shares out to the girls. That can happen without triggering any tax. This is the general rule with trusts. The trust is going to have assets, capital assets. In this case, it's the shares of OPCO. And those shares will continue to grow. It has $100 of cost base. Just prior to the 21st anniversary, let's say a month before the 21st anniversary hits, what we would do is we would wind up the trust. The trustees would take the trust asset, the shares, and distribute them out to the beneficiaries, to Lila and Maya. And let's say they want to give it 50-50. Because as long as Lila and Maya are Canadian residents at the time that you distribute those assets out of the trust, the CRA says it's like a rollover. It's an automatic rollover for tax purposes, like Section 85. Lila and Maya are deemed to have acquired these shares at the trust cost base. The trust is deemed to have sold the shares or given the shares to the girls at its cost base at 100. So you don't trigger any tax. And that means then that Lila and Maya inherit the trust's original cost base. So if they turn around then and then sell the shares of OPCO, then they're going to have the capital gain. But if they don't sell it, and then when they die, they're going to have capital gains tax, right? Because it's death tax. It's going to be subject to death tax. So that is something to be aware of with discretionary trusts. You need to keep that in mind. There are certain trusts that do not trigger this rule. Remember I said if you have an inter vivos trust where we have actually crystallized the value, I've said Lila gets 50% and Maya gets 50%. We're going to keep it in a trust, but we know that this is what they're getting. That's not subject to 21st anniversary rule, like the deemed disposition. And the reason is CRA says, well, we don't need to do that because when Lila dies, she has an asset. She has a real interest in a trust. We know. The trustees have already determined she has 50% interest, so she's going to have a tax on her death. Okay. So that's the end of trusts. Any discussions? Any questions? Yes?
And so the beneficiaries can in turn, once they get the money from the trust, before the 21 years has elapsed, they can in turn put it into another trust.
Actually, they can't do it without triggering tax. The reason is, so remember, cost base, ACB is 100, fair market value is 500. So we wind up the trust, we get rid of this, and let's say we just give the shares to Lila, okay? She inherits the ACB of 100. If she says, okay, now I want to put it into a family trust, and this is a great question actually because I'm going to tell you something else, so I'm glad you asked it. A family trust, it's like as if we transferred assets to a corporation without that Section 85. Distributions from a Canadian resident to a trust is considered to be a sale at fair market value. So if she went and gifted the shares to the trust, she's deemed to have sold it at $500, so she's going to trigger tax. So you can't do that. There's no ability, and there's no Section 85 equivalent rollover for transfer to a trust. You can only do a tax-deferred transfer of property to a corporation or a partnership. You can also do it to a partnership. I did not mention that earlier. So Section 85 tax-deferred transfer of property to a corporation is okay. A tax-deferred transfer of property to a partnership is okay. That section is 97 sub 2. I didn't see that reference in the material, so you may not need to know that. But that's it. That's the only time you can defer tax on a transfer of property.
Just going back where the trust is fixed.
Yeah.
Like that would be the living trust.
Mm-hmm.
And that would trigger, that's not subject to the rollover tax.
Sorry. Sorry, say that again?
So just before you started the questions, you had said if it's a fixed trust.
Oh, yeah.
50,
Yeah.
that's not subject to the
21-year rule.
21-year rule.
Right.
So automatically, when they're transferred, I guess, or when they go to sell it, there's no rollover.
Yeah, so what happens is if we have this trust, so let's say the shares are here, and we have this trust, we fixed it in value. So I'm going to do this, okay? We said this 50% is Lila's, this 50% is Maya. So she is guaranteed to get 50%, and Maya is guaranteed to get 50%. When we wind up this trust and distribute the shares out to them, yes, there's no tax on the distribution out of the trust. It's the same thing as if it was a discretionary trust. The only difference is that this type of trust is not subject to that 21-year rule, where it's deemed to have sold its assets on the 21st anniversary. So we can actually leave this here beyond 21 years, but there will be tax at some point if they never sell, but when Lila or Maya dies, they will pay capital gains tax on their 50% interest. Well, because, well, that's a good question, actually, because sometimes they don't know how they want to give it to kids. The beauty of a discretionary trust is it gives so much flexibility. People will put into place a trust, and their kids are minors. They have no idea where their kids are going to be in 20 years' time. And so they don't want to crystallize. So having a discretionary trust gives them that flexibility to have 21 years to decide who gets what. So when you come to the 21st anniversary, in order to avoid the tax, at that time either you wind up the trust and distribute it out, or you do this, you crystallize their interest. Then you're okay. Yeah. So you can back into this at just before the 21st anniversary.